Fed independence is back in the spotlight. Some bond investors told the US Treasury they were concerned about White House economic advisor Kevin Hassett being appointed to the Fed chair, according to a report in the Financial Times, because he could push policymakers to cut rates too aggressively and reignite inflation. The president has made it very clear he wants to see steep rate cuts, but would they be justified? Russ Mould is investment director at AJ Bell. Russ, firstly, we have had some weak labour market data in the US this week. Does a series of cuts at the next few meetings look justified?
It's certainly what the market's expecting, Elena. We've got one cut priced in for the meeting on the 10th of December and then three more next year to take us down to 3% by next Christmas. Now, we can argue that the equity market's slightly having its Christmas cake and eating it by pricing in strong earnings growth next year and interest rate cuts. But at the moment, they're looking at the market, the economy being not too hot, not too cold, or certainly just cooling enough to, yes, justify those rate cuts.
Shouldn't policymakers worry about the fear that reignites inflation, though?
I'm sure they are, and that's why Chair Powell and his colleagues have proceeded probably more patiently than the president certainly wanted, and certainly than many expected this year. For all of the president's public statements, the official inflation figure, whatever you think of it, is 3% year on year, exactly the same as it was in January. So that is definitely going to be exercising the Federal Reserve's mind. I guess that the big challenge is whether we go into this issue of independence or not. I think it's not just in America where you have the possibility that fiscal policy dictates the monetary policy because of sovereign indebtedness.
Well, yes, and could a combination of this stubborn inflation and looser monetary policy in the new year lead US Treasuries to sell off?
I mean, it's a legitimate worry. I mean, 10-year yields have actually crept lower for most of the second half of this year, perhaps reflecting those softer labour numbers that you mentioned. But since the Fed began cutting rates last September, the 10-year yield hasn't come down very much at all, even though the Fed funds rate has. So I think there are clearly residual worries about inflation among bond vigilantes and about the overall levels of Treasury issuance that we're going to see because of the galloping federal debts. There are still some very big issues in the background that could conceivably box the Fed in, even if inflation and jobs are its main mandate. It's going to have to keep an eye on some of those other issues as well.
Do you think the bond investors buying these treasuries are confident there are enough checks and balances in the US system that President Trump can't exert too much influence on the Fed chair?
That's an exceptionally good question. Again, I think there are some clear residual nerves there, given again that yields aren't really coming down perhaps as rapidly as you'd expect, given the federal funds cut. The government shutdown probably didn't help. I think once we get some more clarity on the next deadline for that in January, that may give bond investors a little bit more of a feel for the direction of travel, at least fiscally. But again, if you're running a deficit at $6 to $8 trillion every presidency when the economy is going well, heaven help them, then what happens if there is an unexpected recession in 2026 or 2027 when welfare spending will go up and tax income will come down? It's quite a frightening thought.
What do markets make of White House economic advisor Kevin Hassett, who looks like he's the man in the frame for the Fed chair job?
Yeah, he seems to be seen as a bit of a dove and certainly sort of pro-Trump, as it were. But, Treasury Secretary Besant's probably interviewed a fair number of candidates, but there are these legitimate concerns. But again, Hassett's desire to cut rates may just reflect his interpretation of the data and this overweening fiscal background, which is galloping debt, an interest bill that's more than $1.1 trillion a year now, and one that's going up potentially if there is with the refinancing wave that's coming up in the next year or so, if interest rates don't come down. So there is a bit of a clock ticking in the background.
The other nerves in the market, of course, have been about the frothiness of AI valuations recently. They seem to have eased off now. Can those stocks move ever higher before Christmas?
Anything's capable of happening in the short term, and clearly equity markets are gearing up for a Fed cut in December. There's always the prospect of a Santa rally. I guess what markets will be looking at are, the clap will be probably waiting now for the first quarter earnings season, if the truth be told, in February and March. But it's intriguing to see both Anthropic and OpenAI talk about an initial public offering in 2026. If you are frightened of a bubble, one thing you'd probably be wary of is if there is a big dash for the exits from some of the smart money and some of the early stage money, because that was one of the things that was an early flag in, say, 1998, 2000, where there was a wave of IPOs and then an even bigger wave of secondaries, which really did tip things over the edge. The old saying, bull markets end when the money runs out. And if there's a big flood of IPOs and secondaries, that can soak up a lot of cash.
That was Russ Mould of AJ Bell. Don't forget, you can watch more videos on Reuters.com.